Passive Pockets is presented by Equity Trust. Today, we're breaking down the multifamily outlook for 2025, from supply and demand to capital markets and LP opportunities. With record new deliveries in 2024 and a shifting macro environment, many investors are wondering where the market is headed next and how to make the right moves in an uncertain year. Will distress finally hit the market? Are policy changes more dangerous than oversupply? And where should LPs be looking to deploy capital? Let's find out. Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm your host, Paul Shannon, and today I'm joined by Greg Willett to explore the current and future state of the multifamily market. Let's dive in. Greg Willett, welcome to the Passive Pockets podcast.
Thank you very much for having me, Paul.
Absolutely. It's been a long time coming. I've been following you for quite a while. You're always very insightful, and I've been looking forward to this interview. So let's dig in. But before we do, can you just give our listeners a little bit of background on your career? You've been in the space for quite a while and you've had multiple experiences, so it'd be nice to hear a little bit about what those were.
Sure, Paul. I have spent most of my career as the real estate guy working in tech world. So focusing on in prop tech firms, but I try and help the technology people understand what's important to real estate owners and operators. And right now I'm with a company called LeaseLock. We are in the tech space, and we help get renters into apartments by replacing traditional deposits with a monthly fee. And then at the same time, we're certainly very concentrated on risk and protecting NOI for the owners and operators.
Very good. And you have a background as an economist, correct?
I've been a real estate economist for my whole career, really focusing primarily on multifamily.
I want to kind of pick your brain a little bit on the market and in specific to supply and demand and where we've kind of been and where we're going. We saw in 2024, I believe, the most deliveries that we've seen as a nation since the 1970s. And there's been some markets that have had trouble absorbing those units, while others have been a little bit more resilient than expected. Can you give us kind of an update on where things stand today and where you see them heading towards the end of 2025?
Yeah, certainly we've been in a heavy delivery period over the last couple of years. And you're right that last year was the peak in that activity. We've still got considerable product under construction right now, and deliveries this year will be substantial. The number that I'm using for the nation as a whole, close to 400,000 units finishing up this year. So that's significant, not quite at last year's level, but it's a lot to digest at one time. Now, I'll point out the 15 or so most active markets account for half of that product. So it's very specific in terms of certain areas are getting huge amounts of new supply and others not so much. We will be winding down this construction boom this year. And by the time we get to 2026, 2027, we're going to be at much, much smaller completion volumes.
So with that said, do you feel like development is potentially a contrarian play right now if you're a passive investor, where there's not going to be much delivered if you can ride the coattails of a developer who has the efficiencies, the cost structure, the contracts in place with vendors, and they can actually get permits to get out of the ground? Are these going to be people that are going to be successful in 26, 27 when there's not much else coming to market?
Developers who can get the financing to get product going right now are going to be in great shape, because yes, in 26, 27, there will be relatively few completions. There will be select markets where we've still got a little bit of a new product hangover from what was finished last year and is finishing this year. But most places, we're going to start talking about undersupply again, probably 12 months or so from now.
Yeah, supply and demand is such an interesting dynamic. It's interesting to me. I have not heard that before, that 50% of the supply has come in the top 15 markets. a lot of passive investors and active investors alike were driven to Sunbelt markets because that's where a lot of the population was moving during the pandemic years and still is, obviously, with all the jobs that are moving to that area. But there's smaller markets where there really isn't a lot of population growth. There's not a lot of job growth, but there is a limit to the supply and there's nothing coming out of the ground. So in those markets, a lot of them in the Midwest, we've seen rents actually tick up, where in other markets, we're starting to see rents go negative. Is that what you're seeing as well?
Yeah, absolutely. And I will defend the developers a little bit. And, in terms of, yes, half the supply has been in a handful of markets, but half the nation's demand has been in those same markets too. So it has certainly made sense. But you're correct that there are markets, particularly in the Midwest and in the Northeast, where we've had relatively restrained development activity, which means that occupancies are really tight in those markets and rent growth is at or above the historical norm. And then some of the secondary and tertiary markets, really in all regions of the country, are looking better than, those handful of really big metros that have had really, really active construction.
So we're not asking you for investment advice, Greg. Let's make that clear. But is there a specific region or area of the country that you feel may outperform here over the coming years?
Well, I am actually a big fan of the concept of just get in front of demand and then figure the rest out. So while we've had a little bit of struggle in some of these major Sunbelt markets, if I were investing in for the long term, I would still be looking at places like Texas and the Carolinas and Tennessee, which I think are going to do really well. Some of the other markets, we talked about the Midwest, they're never going to be rock stars, but it's going to be solid performances, and there's something to be said for having stability in your portfolio, mixing some of those markets in there.
Yeah, so that speaks to diversification, right? And spreading your bets, so to speak, amongst different geographies, potentially different sponsors, maybe even different asset classes. But we're not here to talk about different asset classes today. We're really focused in on multifamily. I do want to touch on two other, I guess you could call it, asset classes that may impact multifamily, so to speak. Do you think that the return to office sort of trend that's happening now with some corporations is going to positively or negatively impact multifamily, or is it really irrelevant to the space?
I don't know that it moves the numbers overall for how much demand there will be. Obviously, it can impact where that demand shows up. And we did certainly have during the pandemic and the post-pandemic period, there were certainly some households who went farther out from the corporate center of the city because that's usually more affordable housing. So some of those folks will probably come back in a little bit. So we're shifting things around slightly, but does that drastically move the needle? Probably not.
What about single family and the dynamics that are happening there with construction, of residential homes, of where interest rates are at and the difficulty for, first-time home buyers to apply and get approved for a mortgage, these types of dynamics? Is single family something that you keep in mind when you look at multifamily?
Yeah, absolutely. And I'll point out that affordability has become very challenging for single family purchase at this point. And the premium to buy versus rent is at record levels. So that is keeping renters within the apartment market longer than they have traditionally. I'll throw a couple numbers out there that I think the typical age for a first-time home buyer has moved all the way up to in their late 30s. I think the number's 38 at this point. So if you're going to stay renting for that long, that is a big difference than what we've seen a decade or so ago with that age ticking up. So, and I'll throw also that build to rent single family product into the mix as well. So these older renters who are not yet ready to buy, whether that's a lifestyle choice or a financial choice, that rental single family product does appeal to them as well.
Yeah, that's a great point, and definitely kind of a shift. 38, that's surprising. I didn't realize that data was available, but that is certainly later in the game than I feel like my generation were buying their first homes or condos. So that's an interesting fact to keep in mind. That certainly favors multifamily and demand there. If there's not affordability to buy single family homes, people will continue to rent. Let's shift gears a little bit, Greg. I want to talk a little bit about the new administration that's come in, the Trump administration. Obviously, there's been talk of tariffs, and some of those have been enacted. Some have been threatened and pulled back. Some are on the docket and being discussed. And there's a whole host of other policies that could take effect that may or may not offer risk in the real estate sector. But what in your eyes is really important to kind of focus on here is we talked about supply risk. Is policy risk a bigger issue because supply is sort of going to figure itself out? Do we know, what to plan for in the future with the administration's policies?
I would certainly say that we're in a messier period than we have been over the past few years. Yes, tariffs are a concern, and particularly that can drive up construction costs. So that would probably put some downward pressure on building activity. But more than anything, what we're seeing right now with the policies of the Trump administration is consumers losing faith in the economy and being more concerned about what lies ahead and general inflation, and what tends to happen there when we're in this state of confusion is you just hunker down and you do nothing. So that, I think, is going to put some downward pressure on new household formation, which obviously fuels housing demand. So people are just going to have a tendency during the near term to just stay in place. So that's bad news for these new completions that are moving through lease up, because I think, again, that household formation is not going to be at the level we would like it to be. If you're an operator, though, your ability to hold on to your residents and resident retention is a big deal on the operations side. You're probably better positioned than maybe you would have thought you were coming into the year.
I look back to summer of last year, and there was uncertainty at that time. Really, the talk was around whether the Federal Reserve was going to lower the federal funds rate, which they did in September, sort of telegraphed their plan through the rest of the year. So we thought we were going to get some certainty there, which we did, but then it kind of shifted to, hey, who's going to get into office? Is it going to be Harris or is it going to be Trump? And there was uncertainty around policy. And okay, well, let's hold off. Let's not make any investment decisions until we have more clarity there. We got clarity.
We got clarity for 5 minutes, Paul.
Yeah, for 5 minutes. That's right. That's what I'm getting at. It was like a really short period of time. And then everybody was like, oh, crap. What does that actually mean, right? So to your point, there's sort of been a stall right now. There's not a lot happening. I know in my market, there's not a lot of transactions coming to market. Buyers and sellers are still sort of a little bit apart between the bid and the ask. And if you don't have to sell, most of the time you're not considering it. So what do you think it's going to take to get transactions to spur again and for buyers and sellers to start transacting?
We did have that brief period of time where 10-year Treasury yields came down back into the threes rather than the first number being 4% or so. So a little bit more product did begin coming to market. You did see transaction activity bump up a little bit. But yes, now that Treasuries have gone back up a little bit, we are seeing that flow of product to the market not great again. But I do think that there will be some pressure to get transactions going a little bit stronger as we move through the course of the year. And a couple of factors come into play. Number one is just how much investment capital there is sitting on the sidelines right now. And some of that's been sitting there for a while. And if you're in institutional capital world, that if you don't get some of that deployed pretty quickly, you're going to have to start giving some of that money back to your sources. So there's certainly some push to get some activity going. At the same time, we talked about earlier that market fundamentals should be improving in 2026 and 2027 as we bring down that new supply number. So I think there is a push you want to take advantage of that upward part of the cycle. So get some deals done late this year because you know that fundamentals are going to look better during the short term.
So maybe don't wait for all the green lights is what you're saying if you're an investor. And we've got some yellow ones, but let's push through.
Real estate capital, where we move as a herd. And whenever it starts coming back, it'll probably come back pretty quickly and in pretty large volumes. What we're seeing, and the first thing that's already starting to move is some of this new product that's been built over recent years. I mean, these are great assets that are going to be terrific to hold over the long term. So some of that product is moving. The value add space is a little bit more sluggish. There's frankly a little bit more distress in that part of the market than there is at the top of the market. So that is sort of a metro by metro. You got to figure it out where we stand on that value add play.
Let's touch on that. That's a good segue. I agree. Like the newer vintage product that's relatively stable, that maybe has had a little bit of a challenge in lease up and absorbing those units. If you can just push through to the other side of the next year, that's going to be a really solid asset to hold that has, low maintenance and isn't maybe as subjected to, pressures on expenses with renovations and maintenance and some of the older vintage stuff. There's not a lot of LP capital that's, really excited about that 1970s C-class apartment in DFW like there was a couple of years ago either. But does that mean that those investments are, kind of washed up and there's not a chance that they'll come back? We've seen some cap rate expansion. Is there a certain point where price discovery occurs and people get excited about that?
Obviously, if the price net comes down enough, you can make those deals work. But it is somewhat more challenging, and it really kind of depends on when was the last time that product traded hands. If it moved during, at the peak pricing in, let's call it 2021 to early 2022, it's going to be a while before those properties can trade hands getting back to that price point. If it's property where somebody's been holding it for, let's say, a decade, then you could still have that property trade and the current owners could make some returns off of that. And then the new buyer could be relatively well positioned. Again, anytime you're talking about that product, very neighborhood specific, very asset specific on whether the deal makes sense.
100%. And I'd say sponsor too, if they're capable of managing the asset, project and asset management, a different, obviously demographic, a different tenant base, a different risk profile for investors. So certainly have to be partnered with the right jockey, not just the right horse, so to speak. But you alluded to distress. We haven't seen it, at wide scale. I think there's even, funds that have come together and raised in a blind pool style to deploy into what they thought was going to be a massively distressed market. And they're sitting on the capital, like you said, that they may be returning to their investors if they can't find opportunities for them. Why have we not seen that wave? And is there potential that we may see it coming this year?
We haven't seen it, and I don't know that we are going to see it in terms of, hey, it's product that went into foreclosure, et cetera. But I think that we are going to begin to see at some point where the banks or whatever financial source is involved in holding the loans are going to force some of these owners to actually sell and, let's cut our losses and move on. But that's not going to be widespread. And I wouldn't even say it's by metro. It's, certain neighborhoods in certain markets. And really it's particularly the markets that got overextended when we were at the top. And I think the two that, I'll throw a couple out there, the two that people are really watching are Austin and Phoenix, where there was so much product that traded right at the top of the market.
And with that product that could potentially be distressed, just for some background, our community is really focused on sort of that middle market syndication style investment. institutional quality stuff is, larger typically, maybe newer vintage, not necessarily the smaller stuff, although there's some that are investing in, the 40 unit property that's managed by a less sophisticated property manager. We're talking about like the 100 unit plus to maybe like 150 to 175 unit. And in this, specific to this conversation and questions that we're having around it, we're talking about C class, B class property. So of that type of property that traded towards the peak of the market, is there going to be an opportunity for our community, our investors, given that appetite, to capitalize on this distress? Or is it going to be gobbled up by institutional players and other funds and such that we may never get to see it?
I don't think the institutional capital is going to, certainly they're not going to chase that grade C product. They'll certainly dip down into some B product in the right neighborhoods, and let's say it's the best located property in that neighborhood. They'll look at that. I think that institutional capital is going to more concentrate on that top tier product, which again, you can buy right now at below replacement cost. So it's very appealing for them. I always like that middle tier sort of play. Let's call it the, 50% of the product that's kind of in the middle versus, the 25% that is the most expensive and the 25% that is the most affordable and lowest price for the renters. That middle market product tends to be more resilient than either extreme. So again, it's a matter of just finding the right asset in the right neighborhood.
You alluded to consumer confidence being a little bit less robust than it had been over the prior 6 months. If we do get a recession, which it seems like is, been predicted for the last 3 years, obviously people lose more money planning for a recession than they do through the actual recession. But if we crystal balled out 6 months and we're actually in that said recession, is that property class going to live up to its sort of, reputation of being able to absorb that hit to the economy better than A class or C class?
Couple of different things tend to happen if you hit recession. And usually recession shows up right when your construction activity is peaking. So that is bad news for Class A product. But it's interesting that we've already managed now we're starting to slow down construction. So even if there's a recession right ahead, we will be past the peak in deliveries. So maybe Class A doesn't struggle to the degree that it would have in past cycles. And particularly that's true if you're not losing renters to single family purchase to the historical degree. So I think that probably Class A would hold up if there's an immediate recession right in front of us a little bit better than it has in the past. I think Class C, which is usually where you start to see some stress simply because the people who live in Class C product just have no financial cushion at all. And so they would be very sensitive to job loss. And frankly, they're just going to be very sensitive to if inflation kicks into higher gear, that they just don't have the finances to deal with that. So from my perspective, Class B, that middle market product tends to hold up best. And that's what I would expect again.
You mentioned inflation. Let's touch on inflation as it relates to rent growth and expense growth. We saw rent growth go through the roof, in the pandemic era, and then really declined in oversupplied markets or flattened out pretty much across the country. But we saw expense growth really kind of catch up. And that to me is the most worrisome thing as an investor looking at an underwriting file is I don't know that local market necessarily as well as the sponsor should as an LP. And I'm looking at their rent growth assumptions and thinking, man, these just feel a little too aggressive, or, their expenses seem a little too thin. And, they're all projections, of course, and where the rubber meets the road is actually operating the property. But how do you balance that if you're an investor? How do you look at a pro forma and say, hey, I can really feel comfortable that we're through the most significant increases here and I can reliably trust this pro forma?
Again, the next couple of years, I certainly do think that rent growth is going to get better than it has been. But let's be realistic. I mean, it's going to get to what's a level that's probably a little bit above the historic norm. But if you're seeing pro formas where you're getting rent growth, high single digits to low double digits, that's just very unlikely to happen, except for in maybe a handful of cases. We will be challenged on the operational front with expenses going up, and particularly pay attention if you're in one of these markets where the insurance costs have been going up so much at this point. I've said that my background is not just real estate, it's also technology. I'm a big believer in technology over time actually bringing down costs. So I think we're going to get smarter on the operational front, but still expect expense growth to run maybe a little bit higher than it has historically.
I would agree. And that's a little unnerving if you have a short-term business plan, right? If you've got more of a long-term approach to your investment philosophy, you can weather that storm pretty easily with the right amount of reserves, which really is the typical way to invest. It's boring. It's longer term. You grow your wealth over time. This get rich quick stuff that happened from, maybe 2015 to 21 is not the norm. So I think there's a sort of education process for those that are new to the space, because syndication and being able to invest in syndications as an accredited investor, or if you go through a 506B as an unaccredited investor, is relatively new, right? It's just kind of become more popular, especially since 2017 with the Tax Cut and Jobs Act being revised. So it's just part of the maturation process, but those outsized returns are kind of returning to the mean, it seems.
Yeah, I mean, from that, mid 2010s right up to when COVID hit, I think that those of us who have been in the industry for a long time said this is the most robust apartment market that we'll ever see in our lifetime. And so I think people who don't have that long-term history need to realize that as well, that we're not going back to that period of the late 2010s. That's just not repeatable.
Well, we're getting towards the end of our conversation, but I'd be remiss not to ask you about capital markets. And I don't want you to get out your crystal ball necessarily, but interest rates have been bouncing all over the place. What's your take on where rates will be here in the coming years and how that will impact transactions? Obviously, if rates go down, there's going to be probably more, but how will they relate to cap rates and just kind of the broader macro perspective? You take into account the other options that investors have. We talk about the risk premium a lot when it relates to real estate, and what you should be paid for is risk, right? If you take on more risk, you should be compensated for it. And certainly private market real estate is more risky than, let's say, just buying a 10-year treasury bond from the government. Typically, cap rates have been about 150 basis points above, let's call it on average, the going in interest rate. That's not the case today. So do we have more cap rate expansion? Do interest rates come down and cap rates stay flat? Where do you think things shake out?
I think there's some difference by product segment, and that we've said that the investment appetite over the short term is going to be focused on that higher end product. And we are already, frankly, starting to see a little bit of cap rate compression for those types of deals. On the other hand, that I think that cap rates are still stable to headed upward in that middle market to lower end product. But that's really kind of returning to what was the historically normal relationship. I mean, we went through this weird period where, the cap rate was 3.5% to 4% for the best property in the most attractive market. And then if you went to Class C product in a horrible location, the cap rate was still 3.5% to 4%. And that just did not make sense. So we're going to move to, there's certainly more of a cap rate spread than we've seen in recent years. And also I think that, we said that market fundamentals are not going to return to what they were in that mid 2010s to beginning of COVID. Interest rates are not going back to that either. I mean, we're certainly are going to have interest rates that are not sky high compared to long-term history, but that period of free money is gone and it's not coming back.
Well, hey, Greg, this has been a phenomenal conversation, very insightful. I know I've picked up a few pointers here and sharpened my pencil. So I want to thank you for coming on and sharing your wisdom with us. If people want to learn more about you, where can they find out?
Again, the company I'm with now is called LeaseLock, and it's easy to find, LeaseLock.com.
Very good. Thank you, Greg Willett. Appreciate you.
Thank you, Paul.
That wraps up today's look at multifamily investing in 2025. Huge thanks to Greg Willett for breaking down the latest trends and sharing what LPs should be watching for this year. If you enjoyed this episode, don't forget to like, subscribe, and leave a comment with your take or questions. For more passive investing insights, visit PassivePockets.com and check out our 7-day free trial. Thanks for tuning in, and as always, happy investing.